I studied all the major stock market recessions that happened over the past 100 years, and let me tell you, I found some pretty interesting stuff that you're going to want to know about. But if you don't want to watch through the entire video, here's a summary of it. On average, modern recessions last around 10 months. The worst one caused the stock market to drop a crazy 86%. And while recessions can be caused by all sorts of things like monetary policies, wars, and even banking crises, they all have one thing in common. They are all different. I bet you have been hearing the word recession a lot lately, and if you are wondering, a recession is a significant, widespread and prolonged downturn in economic activity where you have two consecutive quarters of negative gross domestic product (GDP) growth. A lot of people are saying that our coming recession might be like the one from the Great Inflation in the 1980s, because back then the US federal debt to GDP ratio was standing around 32%, while as for today it's standing around 130%. So people are worried that things would fall apart in the months to come. But is that really the case, and is the next recession so predictable? You'll find out at the end of this video. But before that, you know the saying, those who don't learn from history are doomed to repeat it. Well, that's exactly what we are doing today. We are diving into the past 100 years of US history to uncover the secrets behind the 7 recessions the country has faced. Some were mild, while others were major disasters. But what caused them all? How did the US bounce back from each and every one of it?
The speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
Let's remind you back to the year 1929. The market was good and the US nation's total wealth doubled between 1920 and 1929. It was in fact too good that the market went overly optimistic. Now we all know that the stock market expansion does not go in a linear straight line, but rather cyclical. But hey, the stocks were rising. Let's pour my whole savings into stock. Everything looks great on the surface, but if you look closer, something fishy was going on. As early as 1927, there was a decline in consumer spending and inventory was on a rise, and this led to a decline in production. So by this time, you can imagine that the stock prices and their actual values did not really match. The US Federal Reserve had tried to curb speculation by raising interest rates, but the banks still continued giving out risky loans. And eventually, on the 24th October 1929, the stock market bubble burst. The panic selling happened, and that day is now known as the Black Thursday. On that day alone, the market opened 11% lower than the previous day's close, but little did they know, it was just the beginning. You see, what made a stock market crash truly dangerous and devastating was not the loss of money, but the leverage. People were investing with money that they simply don't have. So when the prices started to fall, it triggered margin calls. Basically, if a stock falls below a certain price, then you're forced to deposit more money to maintain that margin. Or if you don't have enough money, you will be forced to sell your position. So when the crash happened so quickly, many investors were unable to deposit more funds, and so they had no choice but to sell their holdings, which further drove down the prices of assets. You can think of it like trying to escape from the 10th floor of a building when all the floors below are on fire, and the only option you have is the open window. You either risk breaking all of your bones or just game over, right? Millions of investors lost their money, and it took only 2 months for stock prices to decline by 33% from the peak in September. And this marked the start of the Great Depression. And Americans had their longest and most severe economic downturn ever that lasted for a full 10 years. And to make things worse, the banks were involved in the stock market as well. So naturally, they suffered severe losses too. Seeing this, the public felt worried and felt like their money was no longer safe in the banks. So they also started panic withdrawal from the banks as well. And guess what happened? The bank ran out of money to pay everyone, which eventually led to a banking crisis. Back in the 1930s, the banks were far less regulated than today. So when a bank announced a bankruptcy, your lifelong savings were simply gone as well. And adding on a severe drought happening at the same time, everything looked so bad and people stopped spending money. The weak demand then again dragged down the economic activities further, and from 1929 to 1933, the US GDP had shrunk by more than 36%. And luckily, the turning point came when President Roosevelt was elected in 1933. He stabilized the banking system and suspended the gold standard. This allowed the Federal Reserve to introduce a more flexible monetary policy to expand the money supply, i.e. print more money. And eventually by 1940, the US has finally recovered from the Great Depression. So to summarize the numbers, from the 1929 all-time high, the S&P 500 was bleeding for a good 34 months, almost 3 years, and it really hit the rock bottom before a rebound. At the worst time, time, it lost its value by 86% from the peak. And to climb back to the S&P 500 all-time high again, it took another 22 years. What a pain to even see that, right? Unemployment rate between 1929 to 1933 ranged between 3.2 to 23.6%, which means at its worst time, 1 out of 4 people was jobless. And this bad number surely brought down the production as well. So forget about positive economic growth. The annual GDP growth went between negative 8.5 to negative 12.9%, and the deflation went as bad as negative 10.3%. Literally, if you buy something today and it will be 10% cheaper next year. Pretty insane, right? Now let's talk about the recession of 1981 to 1982. This rather short recession was mostly the work of the famous ex-Fed President Paul Volcker, but it was not a monetary policy mistake. In fact, a lot of experts today still think that the recession was necessary. How is it so? Well, this has everything to do with what we now call the Great Inflation, the era of 1965 to 1982, when inflation was running at a skyrocketing rate, reaching as high as 14.8% in 1980. So what exactly happened? In 1971, former US President Richard Nixon announced the collapse of the Bretton Woods system and that the United States would no longer convert US dollars to gold at a fixed rate, and that the value of the dollar was no longer tied to a specific amount of gold. And with this announcement, the US Federal Reserve, led by Arthur Burns, started to print money, and when there was more money in circulation, bang, we had double-digit inflation. But of course, that was not the only reason. The high oil price, tax cut, and increased spending of the government all contributed to the inflation, and at this point no one was happy and the people expected the inflation to stay still. So Paul Volcker, chairman of the Fed at that time, decided that he might as well make the long pain short. He raised the federal funds rate aggressively, which in turn slowed the growth of the money supply, and at one point the Fed funds rate reached a crazy peak of 20% in June 1981. The process was surely painful and caused a soul-crushing recession, but it worked. The inflation stopped, and for the next couple decades there was never again a huge inflation problem in the US. Well, until 2022 that is. So how serious was the recession in 1980 as compared to every other recession? Well, the market took 20 months to drop to the bottom, or about 26% down from all-time high. But to return to that all-time high, it took only 3 months, making it a quick comeback. And between 1980 to 1981, the unemployment rate fell to between 8.5 to 10.8%, while the annual GDP growth ranged from negative 1.8 to 2.5%. And of course, the inflation peaked at over 14% in 1980. And of course, we have more, the next one in line, the 1990 global financial crisis. Time moved to the 2nd of August 1990, the day when Iraq invaded Kuwait with 100,000 troops to avoid paying the massive debt due to the previous war with Iran. In response, the US used its ultimate weapon. That's right, it imposed sanctions on Iraq. Eventually, Iraq was defeated and retreated from Kuwait in 1991, but the oil supply from Iraq was disrupted and the prices rose sharply. At the same time, the US economy turned weak due to their tightening monetary policy, where Alan Greenspan, the then Fed chairman, raised interest rates in the late 1980s to combat inflation, and this made borrowing more expensive for businesses and consumers. The combination then led to a decline in consumer spending and a slowdown in the housing market, and as a result, many businesses reduced their investments and there was a decline in overall economic growth. So the increase of interest rates, decline in consumer spending, slowdown in the housing market, when combined with the war, were the perfect ingredients for a recession. If you look at the numbers, the S&P 500 dropped to its bottom and returned to its all-time high within 1 year, with the maximum drop at 18%. And between 1990 and 91, the unemployment rate peaked at 7.3%. GDP once went negative at 1.9%, while inflation went up to 6.1% thanks to the oil supply shortage. And although the US economy took a downturn, it did not take much time or huge damage for it to stand up again. And of course, the next crisis was on its way too. Moving on to the Asian financial crisis, which started from Thailand. In 1997, the Thai government ran out of foreign currency, and at that time, the government had fixed the value of the Thai baht to the US dollar, and this meant that the value of the baht could not change no matter what was happening in the global financial markets. But this got to be changed. Let's find out why. In the late 1980s and early 1990s, Asian countries like Thailand, Indonesia, South Korea, and Malaysia were growing at an impressive rate with easily more than 8% GDP growth annually. Everything looked great, the people of the nations were happy, and so did the investors, but nobody noticed that it was a house of cards and there was actually a dark storm brewing. Back then, the developments were heavily relied on by export and foreign investment, and these countries had pegged their currencies to the US dollar at a fixed exchange rate before the crisis, which meant that their central banks would buy or sell their own currency in order to maintain a fixed exchange rate with the US dollar. Well, at that time, it was believed that pegging their currencies to the US dollar would provide stability, attract investment, and promote economic growth. But then in the mid-1990s, the US had recovered from its recession and the Fed raised the interest rate. So now the money flowed out of the Asian countries and back into the US market again, causing the dollar to go so strong. And since those Asian currencies was pegged or fixed to the dollar, their values appreciated as well. And this made their exports to be less competitive because it's getting more expensive for other countries to buy from them. And the vicious cycle again started as more money was withdrawn from the countries, and in order to maintain the exchange rate to dollar, the Asian governments had to buy their own currency using their foreign reserves. And as the outflow of capital continued, there was a huge pressure for them to depreciate the currencies. The Thai government was the first to run out of foreign currency to support its exchange rate, forcing it to float the Thai baht, which meant that its value would now be determined by supply and demand in the market. And as a result, the value of the baht collapsed immediately afterward. And the same also happened to the rest of the Asian countries, including Philippines, South Korea, and Malaysia. And in order to get through this crisis, the IMF, short for the International Monetary Fund, had to provide billions of dollars to help Thailand, Indonesia, and South Korea to recover. While the crisis was devastating for the affected countries, it had a limited influence on the United States. There wasn't any recession in the US, and what more, they received benefits of getting cheaper Asian imports. And while this crisis escalated in Asian countries, some parties were actually making money out of it. Out of all, George Soros was famous for betting against the Thai baht. He first traded $1 billion for 54 billion baht, and when the value of the baht dropped almost half, he used the forward contract and walked away with $2 billion. Naturally, there was criticism and he was accused of taking advantage of the misfortunes. Quick pause, if you're enjoying this video so far, you can support this channel for absolutely free by checking out Interactive Brokers in the pinned comment down below. Start trading with the most reputable and well-regulated broker that allows you to trade fractional shares in the US, for which many other brokers don't offer. And the best of all, their fee package is easily one of the cheapest among all other stockbrokers. Thank you so much. Okay, back to the video. The next recession is something that more of you might have heard of, the dot-com bubble. This is literally the consequence of having too much fun partying, and of course, in this case, we call it the stocks frenzy. In the late 1990s and early 2000s, the internet companies grew like crazy, so fast that their stocks were valued at a ridiculously high price even though they were not making a profit. But you know what? They would tell you, internet is the tomorrow, and wow, everyone loved that concept, and the bubbles were blown without real underlying assets to justify the valuation. And eventually the bubble had grown too big and had to pop. Again, the investors were left with no tears to cry. It is interesting that Warren Buffett did not join the blowing of the dot-com bubble while everyone was busy throwing money into the fast-to-get-rich stocks. And at that time, people thought that he made a huge mistake, but like almost every time, he was proven right again. Now, looking at the numbers, the S&P 500 had been losing its value for 2 years, and it took another 4.5 years to recover from the loss of nearly 50% of its market value. And although it certainly caused a hole in the pocket of most investors, the economy was doing rather alright for a recession. So throughout the year 2000 to 2002, the unemployment rate was around 3.9 to 6%, higher than it should be, but still not so serious. And other than that, the annual GDP growth was kept at a positive of 1 to 4.1%, and the inflation was in a rather healthy range as well. So overall, it was a mild recession that affected mainly the investors that threw money at random internet companies with crazy valuation. Now let's talk about the next big one, the 2008 Great Recession. This 2008 crisis surely came big and with its effect long lasting. It is 2023 today, and some still say we have not really fully recovered from this Great Recession. There is a famous movie, The Big Short, that gives an immersive view of what happened in 2008, but let's go through it quickly. Back in the early 2000s, the US had just experienced the dot-com bubble burst, corporate accounting scandals, and the 9/11 terrorist attacks. The Fed thought that they should step in to stimulate the economy, hence the interest rate was lowered to 1% in June 2003. All of a sudden, the cost of borrowing was so low and people sure took advantage of it. A normal working class can now suddenly afford to buy multiple houses with a loan. Even the subprime borrowers, those with poor credit, could own a property, and thanks to the easy loan built on the trust that everyone will pay their mortgage loan, now the nation's wealth was built on a high leverage, and to make it worse, the loans were pegged into derivatives for a resale and was passed on to more people and more investors. And to help you understand what that means, let's say a bank has made 100 home loans to people, but they don't want to take the risk of people not paying back the loan, so they package these 100 loans into a single loan derivative and sell it to investors who would receive payments for owning the loan. And those derivatives were advertised as safe, but a lot of them were actually low quality loans given out to people who can barely afford their mortgage. So naturally, the housing bubble grew larger and larger until one day in 2006, the home ownership had reached its limit and home prices started to fall. This caused a big problem to homeowners because they expected the house price to go up and only up, but in actuality, the houses were no longer a valuable asset that can be sold to make profit, and at some point, some people still owe the lenders even after selling their house. The market was punished hard for the overexpansion of credit. The decline in the value of these mortgages caused a major loss in banks, and that led to a credit crunch. Basically, they went from a mode of happy lender to a frugal one, but that did not manage to save all of them too. One by one, they were having difficulties. Even Bear Stearns and Lehman Brothers, two of the largest investment banks in the US at that time, could not survive, and over 600 billion was lost in their collapses. The fear spread everywhere with the market free falling, while normal people were losing jobs and homes, and people all around the world felt the pain as well. Eventually, the US government had to pour in around $1.8 trillion of economic stimulus package, relief program, etc. And just to give you a sense of how bad things went, the interest rate was lowered to almost 0% to save the US economy from total annihilation. So to summarize the Great Recession, after 60 months of falling to the rock bottom, the S&P 500 took another 4 years to recover from the 56% loss from its all-time highs. And from 2008 to 2009, the unemployment rate was up to 9.9%, and that's like 1 out of 10 people who did not have a job back then. Meanwhile, the GDP had a range of negative 2.6% to a barely minimum positive of 0.1%. Inflation, on the other hand, was actually at a low rate of 0.1 to 2.7% because people simply could not afford to spend more as there were lots of uncertainties. Last but not least, the COVID-19 recession. If you were born in the Generation Z from and after 1995, all these crises might feel like a grandmother story that you don't resonate with. But hey, there is a story that you can tell your grandchildren in the future too, which literally just hit us hard, and somehow we are still stuck and adapting to the new normal, the COVID-19 recession. Since it is a story that everyone knows, I will cut it short and cover the US only. So I'm sure you all can relate. Nothing was open, be it the school, the shops, the theaters. Nobody was spending money in the time of uncertainty, not when people were losing jobs or going to lose one. But hey, the US government had seen this before. Same step. Cut the interest rate to zero, large-scale asset buybacks, the stimulus and relief package, yada yada yada. Basically everything to put economy back on its track. And with all the maximum efforts, whoops, while the virus persisted, the COVID recession lasted just 2 months only, the shortest in US history. And if you look at the chart, the S&P 500 lost its value by 32% from its all-time high in 35 days. But to rebound back, it took a fairly short period as well, at only 5 months. The US unemployment rate rose as high as 14.7% in April 2020, the highest since the Great Depression. But thanks to the quick rebound, the recorded unemployment rate of 2020 was only at 6.7%. As for the GDP, it shrank by 3.4% with a rather low inflation of 1.4%. Well, the shortest recession in history sure had some payback because the loose monetary policy, together with the broken global supply chain, oil supply, food supply, and various other factors, push inflation to happen and force the Fed to raise the interest rate again. And at this point, you can see it's easily a cycle that's always repeating itself. So now that the fear of recession is coming, should we all be afraid? Well, let's look at it this way. Sure, the longest time it took for the US stock market to rise from the bottom back to its all-time high was 22 years, but my 2 cents is that we will not have to deal with that. Back then, the banks were far less governed and regulated, but the US had learned the lesson enough. Just look at how the response of the US government during the COVID-19 recession. They were fast and had more tools to avoid the same thing twice. And circling back to my point earlier on whether the next recession will be an exact replica of the 1980 Great Inflation, well, like I've said, the current US federal debt to GDP ratio simply doesn't have enough room for the Fed to raise as much interest rate as what Paul Volcker did back then. So technically, that option is out of the table. But if I were to make a wild guess, the next recession would most likely be triggered by some sort of geopolitical tensions which spirals into a trading standoff, and that could be due to the Russia-Ukraine war which disrupted the global oil supply, US-China trade wars, or anything along the line. But that's just my guess, and I could be right and I could be wrong. And also, although all recessions came horrifyingly, the market eventually recovered and achieved a new all-time high. So it's probably not a bad idea after all to just dollar cost average and stay invested in the market for as long as possible. If you walk away because of the "this time is different" mindset, trust me, you will never enter the market even though the market crashed 50%, or if the market goes up another 50%, and you will eventually miss the trade. And hopefully by knowing the history, this helps you to stay calm in all phases of the economic cycle. And if you do enjoy this video, a like, a comment, and a subscribe help me goes a long way. So as always, thanks for watching. I will see you in the next one.